Good evening, ladies and gentlemen. A very warm welcome to all our participants, dignitaries, our esteemed speakers, panelists, and industry representatives to the panel discussion on inflation outlook covering 3 C's: crude, currency, and crops, organized by Economic Policy and Government Representation Committee of IMC Chamber of Commerce and Industry. All participants will be muted to avoid any disturbances during the course of the session. All except the speakers are requested to stop video streaming. Kindly post all your relevant queries in the chat section so that the same can be addressed as time permits. As we commence, may I request Mr. Juzer Khorakiwala, President, IMC Chamber of Commerce and Industry, to present the welcome address. Over to you, Mr. Khorakiwala.
Thank you, Selvi. Good afternoon, everybody, respected speakers, distinguished guests, ladies and gentlemen. On behalf of the IMC Chamber of Commerce and Industry, I'm pleased to welcome you to today's panel discussion. As a responsible chamber, IMC constantly engages in and debates matters of economic, commercial, and social importance so as to be able to provide policy inputs for the government. An important issue we attempt to grapple with is inflation. Inflation, especially food inflation, hurts the poor the hardest. Importantly, inflation raises concerns amongst policymakers and encourages the central bank of the country to pursue a tighter monetary policy. Reduced liquidity and rising cost of money hurts the top line and bottom line of businesses. The backbone of our economy, the SMEs and MSMEs suffer. International crude oil prices have a strong bearing on our economic performance as our import dependence is nearly 80%. As a universal intermediate, crude oil is a critical input that fuels economic activity. Massive import dependence on crude oil makes our economy vulnerable to international price volatility. Domestic agriculture output and prices too have a direct bearing on inflation, especially food inflation. So it is important to closely track developments in the agriculture sector. It is also necessary to track the international markets and prices for agricultural commodities. Currency, or more specifically the exchange rate, has the potential to skew price trends. A weaker rupee makes imports expensive. So the 3 C's, crude, crop, and currency, form a potent combination to impact inflation. And for our policymakers, containing inflation through appropriate fiscal, monetary, and administrative policies has always been a priority. This afternoon, we have assembled a very distinguished panel of experts to crystal gaze into the 3 critical markets: crude, crop, and currency, as well as other drivers of inflation. Very warm welcome and a special thanks to our speakers. Mr. Atul Joshi, Founder and CEO, Oyster Capital Management and Advisory. Mr. Jayaraman Krishnamurthy, Founding Partner and COO at Almus Risk Consulting LLP. Mrs. Rajni Panikar Lamba, Vice President, Phillips Capital India Private Limited. And Mr. G. Chandrasekhar, Economic Advisor of IMC and Director of IMC ERTFs. Let's get our insights from these experts. Where is the crude market, oil market going? Will the rupee weaken or strengthen? What are the crop prospects? What are the market dynamics and outlooks for the coming months? And what is the Ukraine-Russia situation likely to be, and how it will impact the 3 C's in the longer term? And impact also the inflation. I firmly believe that all these 3 C's are very important as they have an impact on the other 3 C's: cash, corporates, and our countries. Before I conclude, let me give you a little brief about IMC. The Chamber of Commerce of Industry with a rich legacy spanning over 100 years of excellent service to trade, industry, and commerce. With its membership base of over 5,000 members and over 150 trade associations, the Chamber represents and advocates interests to over 400,000 businesses and industry establishments across the country from diverse sectors of our industry. Through its various expert committees, IMC provides policy inputs for the government, both central and state, and is continually engaged in interaction with policymakers at various levels. The Chamber is now a cradle for nurturing young talents and promoting emancipation of women through Young Leaders Forum and Ladies Wing, which have become embodiment of youth, enterprise, and positivism, proactive thought leadership, and movement for women empowerment. The theme for this year is Engaging Maharashtra, Building India. Before I conclude, once again, I welcome you all to this contemporary and thought-provoking discussion. Over to you, Selvi.
Thank you, Mr. Kharakiwala. I now welcome our moderator, Mr. Atul Joshi, founder and CEO of Oyster Capital Management and Chairman, Economic Policy and Government Representation Committee, to initiate the discussion. Mr. Joshi is a renowned economic policy veteran and an experienced banker with 30 years of experience. Earlier, he was the managing director and CEO of Fitch Ratings Group, heading India and Sri Lanka operations. And the panelists joining him in this discussion are Mr. G. Chandrasekhar, Economic Advisor IMC and Director IMC ERTF. Mr. Chandrasekhar is an economist, senior editor, policy commentator, and a global agribusiness and commodities market specialist. Ms. Rajni Panikar Lamba, Vice President, Phillip Capital India Private Limited. Ms. Lamba specializes in research and advisory services on oilseed complex, grains, cotton, and is responsible for designing customized hedging and trading strategies for large commodity corporations and trading firms. Mr. Jairam Krishnamurthy, co-founder, Almus Risk Consulting, heading the research and advisory for clients. Mr. Krishnamurthy is an ex-banker with over 30 years of experience in treasury operations. He has worked in treasuries of nationalized bank, private bank, and French-based foreign bank. He has guided various large corporates to manage the market risks effectively with his knowledge and wide experience. Welcome to the elite panelists. Thank you, and over to you, Mr. Joshi.
Thank you, Selvi. Thank you, President, for your kind words and setting the stage for today's discussion. I think we are passing through some historic times. We probably do not realize as history evolves and we do not see the events in its magnitude. Maybe the future generations would be able to refer to this last few years and especially 2022 as a historic event which had an impact which could potentially last over a century. Let's look at, I think there are three components which are kind of developing in the back end. One is the product and its production, which is whether it is crude or it is food grains or it is oil seeds. We are seeing some issues with respect to production and supply of products. That is one pillar. The second pillar is the disruption in the logistics. We see that there is no availability or lesser availability of shipping, containers, etc. That's a second piece, which is disruption in the logistics. It also adds to the overall cost burden. And the third pillar, and very important one, I think, is the disruption in the payment system. Very usually people pay in US dollars in the global trade. Now that is actually going into the back end and people are looking at, can I do a bilateral trade? Whether it is with Russia or it is with China or it is between two countries coming together. We've seen WTO receding in the background. We've seen WTO losing its importance over the last 10, 15 years. What is going to happen to the payment mechanism? That's another question which is evolving. We are seeing countries working towards some solutions. So these are the things which are happening at the back end. I think these are the three key pillars which are impacting the global inflation. It's not particularly impacting one country or India specific or US specific. These three things are impacting the global inflation. Every single country is impacted. Now let's look at home ground, what is happening in India. And I would say that a very important decision by the government of India, that is to participate in the global trade market by supplying food grains from India. That would have its own ripple effect whether it's going to impact the MSP or it's going to impact the secondary market price, which the consumers pay in the retail market for food grains. That's something to be seen. But yes, it's a very, very important decision that India has taken as a position that we are going to be suppliers of food grains to the world. Let's see how it evolves. As far as the crude is concerned, we have some bilateral discussions happening with Russia. As far as the currency is concerned, I think by and large, we have seen a very, very stable rupee compared to the events and the magnitude of the events. I remember in 2008-9, for whatever reasons, the crisis was in the US and in the Europe. The countries in the Europe were going bankrupt. What was impacting Indian rupee? That Indian rupee suddenly depreciated by multiple big digits. So let's understand from our panelists as to what are the impacts that these events are going to have on all these three C's, which is the crude, crop, and currency. I would like to invite first Mr. Chandrasekhar to speak about crude. And over to you, Mr. Chandrasekhar.
Thank you. Thank you, Atul. I think you actually triggered a particular thought because we have lived through these times. I'm reminded of what happened in 2010, 2011, 2012 from a commodity market perspective, and what's that being replicated now in 2021 and 2022. Very quickly, I wrote about it in the Hindu Business Line probably 4 months ago. There were 4 or 5 drivers of the market that time after the Lehman Brothers economic crisis, etc. One, we had geopolitical tensions even at that time in 2010, 11, and 12, US-Iran standoff, etc., etc., which raised crude oil prices. Okay. Second, we also had a very liberal monetary policy by the US Federal Reserve and, of course, the European Central Bank, which again is replicated now. And now that, of course, in 22, it's beginning to tighten. The liquidity is, the ultra accommodation is today much less, and interest rates are going to be hiked. But at least until the end of 21, we had a very liberal monetary policy and virtually zero interest rate. The third factor was currency. Same 2011, 12, 2021, 22. It's actually playing out a very weak dollar. A weak dollar obviously pushes commodity prices high. The commodities which are traded in dollar terms. Okay, and now of course in the last 3 or 4 months, after the Fed signaled, the dollar has begun to strengthen, which is what happened in 2013. Okay? And the fourth factor is weather. Exactly, that is playing out 10 years later. 2011-12, we had La Nina in the southern hemisphere, which affected crops, parts of US, and of course most parts of Brazil and Argentina. That's exactly what has happened in 2020 and 2021. And I was amazed by the coincidence after exactly a decade. And then I said, I wonder if this will repeat. Is it a pattern? Will it repeat in 2031, 2032? I don't know. But so all the drivers of the market are all in place for the second successive decade, 2011-12 and 2021-22. Now coming back to our crude market outlook very quickly, I want to mention that crude oil market is actually 90% political and only 10% economic. I think all of us have to understand, and we of course know it. And we know what happened in 2020. WTI went into a negative territory, minus $37 in April, exactly 2 years ago. And Brent collapsed to $16 or around. But 2021 was a very different story. The market, there was a massive turnaround in the fortunes of the crude oil market, massive turnaround in demand because of easing of restrictions across the world in major economies. So much so that Brent spurted by over 40% during the course of 21. And we had financial investment, huge flow of financial speculative capital because of the ultra accommodative monetary policy, which obviously has and always has an exaggerated impact on commodity prices. And then we have in this year, February 22, the Russian attack on Ukraine. and that attack is actually continuing. I, for one, did not believe until December or January that this war will take place. But it has taken place and it's continuing, doesn't seem to be ending. But anyway, and therefore there is a huge nervousness in the energy market at the moment. Now, there are bullish factors and bearish factors which are playing out. Now, the ongoing geopolitical uncertainty and, of course, the currency payment, the sanctions against Russia and the payment issue, something very real that's adding to the instability and the nervousness. But the crude oil market itself has a very tight supply-demand fundamentals, which is keeping the market prices quite firm. More important among the bullish factors, I would rate Russia's production is falling. Russia is a very important producer, as important as Saudi Arabia. But over the last 3 months, if you've seen the numbers, their production is actually falling. And the biggest dilemma from the demand side is from the European Union. And the European Union is facing one of its greatest energy dilemma ever. They have to buy energy products from Russia, but they are under pressure to impose sanctions. But they will be under a serious energy crisis if they impose sanctions because they're not able to get substitutes. And then you also have among the bullish factors, the latest is the morning's news or last evening news of easing of lockdown in Shanghai. There are about 190 million people in China which are locked down in various stages of severity, but Shanghai is being lifted. That has also given a boost to the crude market, and of course continuing speculative interest. And importantly, Putin made a statement yesterday that is deeply disappointed with Ukraine about the peace talks because it's reaching a dead end. So all these are bullish factors, but these factors alone don't make the market. There are bearish factors, and that is from a demand risk perspective. Oil demand growth is certainly going to slow down in 2022 because of high prices of oil and certainly because of inflation. The OPEC itself actually sees a growth of 3.7 million barrels per day of oil demand growth, but this is down by 500,000 barrels per day from their earlier forecast, which means they are seeing a slowdown in demand growth that they are forecast. And then you also have serious concerns over the Chinese, a new variant of the coronavirus in China, where restrictions have been imposed in many cities. In the US, rig count has been rising over the last 2 or 3 months. And Biden has actually taken a U-turn. He was not in favor of shale oil, not in favor of fossil fuels, but he's taken a U-turn and he's actually encouraging companies to pump out more oil. Therefore, US shale oil output today is as good as it was 2 years ago, April 2020. They have reached that level. And importantly, strategic oil reserves, 180 million barrels by the United States, and of course, International Energy Agency members, several of them, including India, they all combined is about 60 million barrels, and all these are bearish factors. Therefore, there's a tug of war between the bullish factors and the bearish factors, and that is what we need to take on board while we analyze this market. And here comes the outlook. I want to mention, at least my research, my reading of the market is very clear. There's a huge uncertainty over future supply outlook. We don't know how supplies are going to pan out. Any push from the European Union to ban Russian oil will certainly tighten the market further, because Russian oil coming to Europe is about 7 million barrels a day, a big quantity. And therefore, if that oil is not available from Russia, I think that's going to tighten the market very substantially. That can potentially take crude to even $150. I will not be surprised. And more important, those European buyers of Russian Urals crude, which is basically a medium sour crude, will have to find substitutes. But enough substitutes are not available. and they can't disappoint, the refiners can't disappoint their customers, because quality is important, because with with any other origin, the downstream product quality will suffer. And that's a big worry for the European Union. And other OPEC members, for example, I suspect they will not be able to raise output to the extent of 7 million barrels a day. And certainly OPEC has admitted that it has very limited spare capacity. And therefore, I will not rule out a very big upside risk to prices. I'm not saying it will happen, but there is a big risk. And therefore, we need to take that risk on board. And the key to the entire this issue is how Russian invasion of Ukraine is going to conclude. That's the key. We don't know. We can't be betting on the war situation. We have to bet only on commodity, which is crude oil. But that is completely dependent on how this war is going to end, how this war is going to conclude, and when the war ends. And I strongly believe the war has to end. It can't go on forever. Maybe it has happened the whole of February and first half of April, maybe another 2 weeks, 3 weeks, 4 weeks. But at some stage, it has to come to an end. My sense, once it starts, once it concludes over a 3-month period, Brent or crude oil market will certainly correct from the current levels of something like $105. It will first come towards $90 a barrel, and over the following 3 months, it'll be around $85 to $90 a barrel. Therefore, as a nation, so much dependent on oil, 83%, 85% dependency, we have got to be careful. We are importing inflation, and that inflation is here to stay. And therefore, we need to use all the tools at our disposal to ensure that inflation does not hurt the Aam Aadmi of this country. And that's the call, that's the conclusion I want to make. Thank you very much, Atul, for the opportunity.
No, thank you, Mr. Chandrasekhar. So you are basically predicting oil to stabilize at around 90 and around 80 going forward. Is that
85, 90 in the second half of the year, provided
yes,
this war situation concludes reasonably peacefully, maybe in this quarter. Yeah.
Okay, fair enough. But what are the chances of that? That remains to be seen.
We don't know. We don't know.
And one of the analysts could be that Russia would actually drag it on and try to bring it to the winter times, because everybody is talking about what Europe is going to do. Nobody is talking about what Russia could potentially do.
Exactly.
And if there is a retaliation from Russia, Russia could simply occupy and extend the war, bring it to the winter times, and then the Europeans have no choice but basically they're dependent on the Russian gas. And a new payment mechanism could emerge between Europe and Russia. The banning or the sanctioning of the oil also from Russia could also come under a question mark. We will look at those.
But 1 second. My sense, personal sense, is that winter is at least 6 months away.
Yeah.
Sorry, start of the winter. And therefore, it's going to be rather difficult for Russia to drag this situation, war situation, for 6 more months is my feeling. But anything can happen in this world.
Anything can happen. So that's right. So that's bring us to the next topic. Crude has its own direct impact on India's budget, which is we are very large importers of oil and dependent on the external sources for our satisfying our oil requirement. But it has a roundabout effect on the transportation cost and other things, which fuels the other inflation part within the country. And let's look at the crop inflation, which is where the RBI takes a call on CPI. And RBI has already predicted that of the next 4 quarters, the first quarter is going to be above 6%, which is the tolerance level or the upper limit of the CPI set by RBI itself. So the whole quarter, the average is 6.3% or so. So which means that RBI is expecting CPI to be above its tolerance limit for the whole quarter, the first quarter, April, May, June 2022. But what does it mean going forward? Because RBI has actually given a zigzag scenario for the CPI. Let's understand from our panelist. Welcome to you, Rajni. If you can just throw some light on how do you view the food inflation or the crops inflation evolving in this country? Over to you. Thank you.
Thank you so much, Atulji. Pleasure to be here and address this August audience. Jumping in right to the topic for the webinar, the impact on crop, the outlook of crop and its impact on inflation. So to start with, of course, the March CPI was just announced yesterday, and it came in at a 17-month high, as all must be aware, at about 6.95%. We were looking at to be it around, as Phillip Capital, we were estimating it to be around 6.7, and consensus was about 6.4, but it has beaten consensus and it's come higher. So when we crystal gaze, how does it look? Our view is that the CPI by December of 2022, we are expecting it to taper off to something like 6%. The RBI level that it looks at by December 2022, not necessarily in the next quarter. And the reason that we think that it would taper off is primarily basis on the lower food prices that we are estimating. And we are looking at a food CPI to come down to about 4% from the current 6%. The reason for the food CPI to come down is one, the base effect, and second is the seasonality as we get into our Kharif production, and Kharif arrivals start from October onwards. So the last quarter should see Kharif arrivals coming in, and that is why we are estimating that CPI could come down to 6% from the current in March, that was 6.95. As I said, on the food inflation, food CPI also, we are looking at it to go down to 4%. Now, if I get into the details on the food side, we saw that, food inflation, food CPI that came out in March was about, the food prices was at about 1.3%, and it was one of the highest growth component for CPI. On the food side, we saw oils and fats in March gaining by about 5%. Now, this is where we estimate going forward some pressure to start coming in, because just like crude oil, even edible oil, India depends on imports for about meeting 65–60% of the domestic requirements. Palm oil, being one of the largest edible oils that gets imported, is entering into what we call as peak production months from April onwards, and it tapers into October. So given that given that palm oil production will enter into seasonal peak production, plus there is an estimate that this year palm oil production globally would increase to about 77 million tons, which last year was flat. A year ago, it was down 1.2 million tons. So we see that supply from palm oil bringing down possibly our oils and fats inflation in the food CPI. That is one aspect that we are keenly watching. The South American oilseed harvest also starts hitting from April. Though the oilseed supply and the stock scenario is tight, but having said that, high prices are there. There's going to be demand destruction, arrival time, and in palm oil, of course, seasonal high production. So all these factors we expect to weigh down on oils and fats, which is one of the key components causing this spike in food inflation, food CPI. So that is one aspect that we look at. Then when we look at the other food articles in CPI, when it comes to cereals, paddy, wheat, pulses, etc., of course, there has been very sharp increase in prices so far. Paddy, for example, year on year is up 20%. A key oil seed like soybean is up 24%. We have sugar, which is up 7.5%. So, as it is said, that the cure for higher prices is higher prices. That is something that I really like, that adage. So given such high prices into the Kharif season, we are looking at increased acreage to come in, whether it is oil seeds, whether it is paddy. So given, we are looking at something like a 5 to 10% increase in planted acreage, given these strong returns that we have seen for these crops, and which is why we expect supply to increase. Of course, I will not miss out the fact that all this will depend on our southwest monsoon. So right now, we don't have any of the IMD forecast. We had SkyMet, which is a private forecaster, coming out yesterday with its latest report, in which it has put southwest monsoon to be normal, about say 98%. It is what is forecasting of the long period average, plus or minus 5%. We have also lingering La Nina, which means that we should have favorably good monsoon. So fingers crossed. On the weather side, we are perhaps looking at another year of normal monsoon. High prices of most of the cereals and key kharif crops should encourage farmers to go there and increase acreage across. Um, the risk to the production, of course, southwest monsoon, which, like I currently said, there are no red flags, but the higher fertilizer prices, which is perhaps a linkage that we have to draw from the Russia-Ukraine war, which has increased by 30-40%. Of course, government has stepped in to import fertilizers, but they still remain high, and we have to see that how much of this will get passed on to farmers. Will it impact yields? So these are perhaps concerns on that we have to look at. But having put all these together, I would still like to remain optimistic and stick our neck out with this forecast that we are looking at inflation, a CPI coming to about 6% in December 2022, and of this food CPI to be about 4%. So that's what I have, to summarize. If there is anything in particular that you would like me to address, and I could, of course, take it.
Yeah, I mean, if you could just dwell upon a little bit on, the India's decision to participate in the export market or the global trade market by exporting food grains. We do have excess food grains is what we understand, but it also means that the traders and the middlemen are going to start buying at a much higher price. Sourcing might happen at a much substantially higher price than what it is today, which could then again fuel, despite the supply, the food prices up in the short term, let's say over the next 3 to 6 months time frame, till Kharif kicks in.
Yeah, so currently, if we look at, when it comes to food grains, it's wheat that will play a critical role. Now in wheat, as is well documented, we do have, production and stocks included about 140 million tons, all put together. And our domestic consumption, including the PDS, everything does not exceed more than 105 million tons. So we do have an excess 35 million tons that can be exported. Currently, I think the export numbers that we are with is about 8.5 million tons or so. Given that kind of a scenario, there is enough supply without it impacting the inflation scenario. That is what we look at on wheat. Sugar again is also finding a lot of exports interest. Because all the commodities are rallying. There again, we have surplus about 8 million tons or so. So the current scenario, the way it looks like, it's a silver lining on a dark cloud, if I might say. We are getting an opportunity to export our surplus grains, sugar, maize. So at this point in time, the way we look at it, given that we had supplies in these key commodities, exports is really not a concern. And given the fact that government monitors CPI with hawk eyes, we are from the commodity future segment, so we are bearing the brunt of it. So ask us. I don't think the intermediaries or the traders will have can laugh themselves to the bank. We have a government which very closely monitors, rightly or wrongly, the decisions that they come out with. But at this point in time, to answer your question, the way we look at it, it's not a concern because these are all surplus supply.
Great. No, thank you so much. Thank you for clarifying the question, because it was always lingering in my mind. It's going to have a side effect or a ripple effect at the consumer levels. Thank you very much. Let's now then look at the last piece of the 3 C's, which is the currency. Let me straightway invite our panelist, Mr. Jairam. Over to you. Over to you, sir.
Yeah, thank you. I'll just share a small presentation.
Sure.
Okay. Okay, are you able to see the screen?
Yes.
Yeah, okay, thank you. So I think we had look at this chart, the Indian rupee has actually been outperforming the dollar index during the entire calendar year 21. Dollar index has gone up by about 8.5%, and rupee has actually lost only about 3.5%. And this is also alongside the fact that inflation in both the countries have been going up. Of course, the US inflation has gone up much higher than the Indian inflation. But I think with that, the good story ends for India, because the challenges for India have now just started, according to me. And it started somewhere in the middle of the year 21, when the FPIs started pulling out large amounts of money from the Indian markets. And to give you a specific number, we had about 18 billion of equities pulled out from Indian market by FPIs. And in the first 3 months of this calendar year alone, we had about 12 to 13 billion pulled out from the Indian market. And that's a very large amount. It is the largest pull out of money from Indian market by FPIs ever since we allowed FPIs into the Indian market. And look at the other side, FIs bonds, they have been selling bonds for the last 10 quarters, and the total amount sold by them is about 2.35 lakh crores. And it is not just the inflation number above 6% is in the last 2 quarters, but they have been pulling out even before, because the Indian fiscal position has become precarious after the COVID. And then the borrowings that the Indian government is planning is something that people cannot fathom how it can be met without heavy lifting by RBI. So it's actually putting off the foreigners, the fiscal and borrowing position. Of course, the global inflation trajectory has only added to the selling pressure. The 6.95% inflation that yesterday we had could not have come at at a worse time. Apart from the fact that even the Ukraine war was also very bad timing as far as we were concerned, and that only put our macros into a big question mark. FI outflows, of course, has been very high, both on the bonds as well as the stocks. But what has sustained the rupee is really the FDIs and the corporate fundraising, as well as the RBI's selling the dollars intermittently to avoid any increase in the imported inflation. So this is how the RBI has been. In the last few months, you can see that RBI has actually been selling dollars, whereas they were actually buying a lot of dollars earlier when there were large flows into the Indian market. In the process, they have also maintained the Indian rupee in a narrow band of 102 to 105 as far as the real effective exchange rate is concerned. Actually, it has given a sense of stability, but this sense of stability in the last several months might have actually made us a bit complacent, and now it appears that the challenges are just increasing. You look at the India's imports, the oil is constituting one of the highest component of our import at 31.9%. It is one among the highest among the major countries, and oil prices going from around 85 in the beginning of in the middle of last year to around 139, and now looking to stabilize around 100 is not a good news for us. And I think in the last budget we had assumed oil around $75 to $80, and that's not good news for India. So that is one of the challenges. Look at the trade deficit, and since September our trade deficit has averaged around 20 billion per month, and it compares with about maximum of 16 billion per month pre-pandemic. I'm not comparing the 2021, I'm comparing the 1920, and this has been contributed largely in part to the higher crude prices, higher import of crude in actual quantum, and then of course the gold import, which has gone up substantially. So the demand side, as the economy grew, has gone up, and the imports have been substantial, leading to higher trade deficit also. So given all this, my outlook for the rupee is that we are somewhere in the same position where we were in the beginning of or end of 2012 or beginning of 2013. We had even at that time our current account had tended higher. Crude had gone up to 128 at that point of time, and US interest rates had started to turn. They started to taper the QE, and that is exactly what we are seeing now also. We have oil prices which are stabilizing above 100. Fed is looking to tighten rates at a substantially higher pace, Probably they will move towards 3% by the end of this year if you go by the dot plot of the last Fed meeting. And then we also have market is probably not even contented with the balance sheet reduction by Fed starting perhaps from the next month when they meet. So they're actually going to announce the plan for the balance sheet reduction. And of course, US has its own, I would say, political constraint that, they're focusing so much on inflation now that experts are even now calling, it doesn't matter if you have to crash the stock market and slow down the economy so that you can bring down the inflation. I think it has become a political necessity for Biden because the next midterm election is coming up. And that explains why Powell, who was on the verge of, the next term being confirmed, actually had to make a big U-turn. From transitory inflation, he had to come to sustainable inflation, and now anything can be done to contain inflation. That is where they are. Of course, as I said, the position for India is actually now on the worsening side. Current account deficit projection for next year is between 2.5 to 3.5, and I don't know. FPI flows, still there is a question mark because when Fed is tightening and balance sheet reduction is around, I don't think we'll have any large FII flows next year. Even I would say FDI flows, which have been sustaining us at an average of around 40 to 50 billion every year, that may be also questionable for two reasons. One, because of the tight financial conditions, and secondly, also the growth projection for India. RBI themselves brought down our growth projection from 7.8 to 7.2% in their recent meeting. So given all this, my sense is that I think we have seen probably the best of the rupee for some time, and we are going to have a challenging period going forward. RBI might do, you can see that RBI's reserves have actually fallen from 644 billion to around 605 billion in the recent data, which means that they have been actually selling a lot of dollars in the market in the last few months. Of course, some of them are also related to the swaps that they did, but really they have sold actually in the outright market as well. And also their reserves have come down because of revaluation or devaluation of the foreign assets held by them. So it is, I think RBI will continue to curb excesses, but if given our view on DXY, about which I'll just deal with in a few minutes, I think given our view on the DXY, which is likely to be pushing even further higher, I don't think they will make a rupee rate artificially strong just to contain inflation. And we will see the rupee weakening further. And just to show it out of the charts, I think we are moving in this narrow channel between 72 and 77 for the last 1 year. And my sense is that we are going to break this as the year goes ahead. My view is for rupee to weaken further beyond 77. So just look at a small bit on the global dollar position also. If you look at the inflation scenario, US has, though with delay, they have responded. They've been responding very well, and they are now preparing the market for hefty rate hikes. We have not seen anything of that kind from Europe. Europe is still, dangling about end-to-end the bond purchases. Although market starts to discount, I don't know whether tomorrow Lagarde will say anything explicit about the rate hike or not. That is the biggest question mark. I am wondering, even after 22 years of Eurozone formation, still the talk of European integration sustainable is coming up. And, it is really for Europe to establish their credibility through their, this chart shows that when the inflation was above 7%, when Germany was an independent, out of the ECB, Europe, then the rate there, the official rate was around 8%. And now at the same level of inflation, ECB is keeping the rate at negative rate. And this is, this is something that's not, keeping their credibility intact. And if you look at the other side, dollar yen, it's a completely different paradigm that we are looking at. If you look at March, normally you would say that yen used to strengthen, and there are a lot of repatriation that used to happen. Yen used, and also with all the risk aversion that is around, stock selling off, bond selling off, you would have normally expected yen to strengthen. But that's not the case now, because the way US yields have gone up, actually yen has become weaker, and the differential with the US and Japan continues to do yield curve control. interestingly, when Japan did the yield curve control, it actually started to do a bit of yield curve control in the US also, because yield curve when they buy unlimited amount of bonds, that money flows out of Japan, and the Japanese investors buy US bonds, which are yielding 2.5 to 2.7% in the from near term to the long term. So the Japanese investors are not bothered about the repatriation this time, and with the inflation expectations in the US so high, the Japanese yen has actually crossed the 2007 high of 125.88. So with two major currencies that is playing their part, I think dollar has been very strong. Of course, the economy strength on the US also is giving the edge, because the unemployment rate, which is shot up to around 15% post-pandemic, has come back to almost pre-pandemic level, and they still say that there are a lot of jobs which are on offer, and wage inflation is very high. And of course, there are some headwinds for the US dollar as well, because people are talking about inversion, yield curve inversion. It depends on which yield curve you are looking at. If it is 2 to 10, they had inverted for some time, but then again now it is in the positive. It is actually steepened. But Fed actually looks at 3-month over 10-year, and that is well into the positive territory. So actually, inversion is concerned, it may be speaking a bit too early. But yes, there are challenges, because when you move from 0.25% to 2% in a matter of 1 year, I think that is something that the corporates will take time to adjust, and the economy will take a long time to come back to the original health. Of course, this is the time lag that you have. Even if you see the yield curve inversion sustainably, you still take a lag of about 18 months. That is what the history shows. But the other challenge for the dollar could be that their trade deficit, which is on the very high side, about $1 trillion in a year, and this is very much unsustainable. And eventually, I think once this cycle of rate hike is over, or at least Fed signals this is where we are going to top out, or if there is any tapering of the inflation expectations, or the supply chains improving, then we probably might see a drastic reversal in the dollar index. That is what I feel, because their macro balances are not very healthy. So that is what it is. ECB and ECB's dovishness and BOJ's yield curve control actually helping the dollar. War impact and energy challenges are actually keeping the Europe subdued. And of course, we do expect some diversification of USD reserves, because there are a lot of talk of bilateral currencies being included in the trade, and Euro may also benefit out of that, because Europe runs a current account surplus, and they're a trade surplus country as well. So one important thing that might come about is while they may be averse to hiking rates, ECB may actually resist weakness in the euro, too much of weakness in the euro, for two reasons. One is it may put question on their stability. Secondly, that may be actually adding to their inflation. So this may be the reason why euro might stabilize. We feel that current level of around 825, we are probably very close to some cyclical bottom. Dollar index itself, actually we think that around 102 is where it is likely to top out. If you look at the cycles of dollar index, it moves in a cycle of 10 years, and we are probably from 2010, when we started to rise, we are actually completed 10-11 years. So we may be due for a cycle turn for the dollar, but then I think this current turbulence has to end before we see actually that happening. Thank you.
Thank you. Wonderful.
Thank you, Mr. Jayaraman. So let me just ask you a question. You have given a 3-month view that rupee could be between the range of 75 and 77.5.
Yes.
Where do you see it, let's say, over March 23, over the next 1 year's time frame? And what would be your advice to the traders, whether they should go ahead and hedge themselves, or they should just keep their positions open? What would be your advice to the traders?
Yeah, thank you. So while I showed you that the rupee had remained stable entire year of 2021, we still had a depreciation of around 3.5%, and that is based on our inherent deficits in the trade as well as in the current account, although we were supported by foreign flows. But given that there is a question mark about the foreign flows in the coming months, or probably in the coming year, I think the annual average depreciation of around 3% in the rupee is not ruled out. And we were closing around 75, and you just add about 3.5% on that. I think we'll get about 77.5 to 78. That is where we think that March 2023 can end. assuming that, dollar index does not overshoot beyond 102.
Sure.
Of course, yeah, as far as the traders are concerned, okay. So as far as the corporates are concerned, I think, see, one thing that has happened is actually RBI has done the risk management for the corporates in the last several months. Okay.
Yes.
Whenever it came down, they protected the exporters by buying a lot of dollars and avoiding rupee getting too strong. And when rupee tended to weaken, they've actually come and sold. So both exporters and importers got very good levels at reasonable levels to hedge themselves. I don't think anybody is unhappy among the corporates in the last one and a half years about their positions, unless they, they got carried away and sold at 72, or they got carried away and bought at 77 post-pandemic. Otherwise, those are kind of risk management that they have to do. But definitely the regulator, the current regime of regulators is actually one of maintaining stability and avoiding any disruptive moves. So that's actually going to be the order of the day. And still, when you get an opportunity, both importers and exporters, they should continue to hedge.
Sure, sure. No, thank you so much. Now we can request the participants to post their questions on the chat box, and we could pick up a question as they come along. Let me just check if there are questions that are coming in. In the meanwhile, let me take this advantage and ask Mr. Chandrasekhar, let me come to you. I wanted to ask you this question. OPEC has generally standing by Russia over the last few months of crisis, and we have seen that they are more on the side of Russia than the sanctioning countries as such. Where do you see OPEC evolving as an organization, given that in the past we've seen, as I mentioned earlier, WTO has receded into virtually irrelevance. UN has virtually gone into irrelevance. People are going more bilateral. Globalization is out of the sync. So where do you see OPEC emerging as an organization over the next, let's say, years or a decade or so?
Good. I think it's a great question. The point simply is it is not OPEC anymore. It is OPEC plus. And that plus is Russia. Russia is as big a producer as Saudi Arabia, for example. Saudi is a leader, OPEC leader in some way, and Russia is equally strong. And therefore, it is OPEC plus. That's number one. My strong sense is that in the short term, OPEC plus will remain intact. Whatever decisions they take, whether to cut production or to hike production, they will all do that jointly. This is number one. But there may be countries like, say, Nigeria, Libya, which may underproduce for their own internal logistics and other issues. But as a group, I think they'll continue to band together and they will continue to stay together. And therefore, in the short term, when I say short term, 1 year, even 2 years, 3 years, don't expect anything dramatic from the OPEC. They will stay together now. But look at a 10-year timeline. In 10 years' time, certainly demand for crude oil, it will slow down. Even 5-year timeline, 5 years from now, demand for crude oil will slow down. Electric vehicles and alternative fuels, renewable energy, all that is going to take over. And therefore, 2030 will be a very different market as far as the crude oil, crude energy markets are concerned. We will have to consume energy, but there'll be much less of fossil fuel and much more of renewable energy. And therefore, once we reach a particular inflection point in terms of demand and in terms of prices, possibly OPEC will come apart. Well, we have seen in the past, in the last 20, 30 years that I have tracked, there have been times when OPEC members, although they stayed together, did not follow a certain discipline, self-imposed discipline. They went wayward, they produced more or they produced less, or they wanted market share, better market share, and therefore they supplied at lower prices, etc. But in a 10-year time frame, I am not bullish about the importance of OPEC for the global economy, because crude oil will continue to be used 2035, even up to 2040. But the importance of OPEC will certainly start declining, primarily because of renewable energy, decarbonization, etc., etc.
Sure,
Yeah,
sure. No, point taken, point taken, point taken. Thank you. Let me just ask one last question to Rajni. Rajni, to your mind, India, as you said, is highly dependent on import for oil seeds. Now, government is trying to push the domestic production of oil seeds, and I believe the area under cultivation for oil seeds has gone up by about 40% odd for this Kharif crop. What do you think is the strategy that India could adopt to stabilize itself in terms of the oil price, the oil seed price shock?
Um, you're right in saying that India is definitely trying to push oilseed production. We've seen the oilseed mission being run for a long time now. We are seeing some of the positive impacts coming in mustard this year, record production. But having said that, the overall yield, whether it's for oilseeds, barring say wheat and rice, in oilseeds, in pulses, our yield is way below global standards. So of course there is a lot of upside room, but we've not seen that potential being, being implemented, or we reaching that global standards of yields for oil seeds, for major other crops, barring, like I said, wheat and paddy. So I don't think that is going to be a quick solution. It is definitely something that is being pursued, and perhaps on a long term, it will hopefully achieve us self-sufficiency. But in the interim, I sir, just 2-3 points that I want to add. Yeah.
Please,
Uh,
please.
what I think could be a solution is having a reserve on edible oils, given that we are highly dependent, is something that I think could work, that the government could use these reserves like we see in China that it does for oil seeds, use these reserves to stabilize prices whenever it spikes, because what government currently does is tamper around with import duties on edible oils, but that is not working. When prices increase, if they reduce the import duties, it's just increases the prices in the origin. So a loss to the exchequer here is actually just making money for the Indonesian and Malaysian planters. So the tweaking of edible oil import duties is not helping. Building a reserve is something that I think can be used to stabilize prices. Using that, if one thing is reserve, the other thing is, the government could import and distribute edible oils in PDS. That also is something that can help to reduce inflation. It will send out the right signals. And lastly, which could be an out of the box, but again, something that China does through its government trading agencies, is send out price signals through the instruments that is available on commodity exchanges, rather than what they have done right now. The government comes in and uses these instruments that are available on commodity exchanges to send the price signal that, if there is a sharp surge in prices, they could have all the combination: price paper signals, increase, use the reserve to increase supply, use PDS, and of course the long term being increasing our oilseed supply. So these are my thoughts. I think Sir has something to add.
No, thank you so much. Really, yes, Chandrasekhar.
Okay, very very quickly, as someone who's been tracking this trade and industry, oil seeds and oil, for close to 40 years, I want to mention we are still in the business as usual mode. The government has said we'll invest 11,000 crores in oil palm, etc. But we haven't made any headway in the last 30 years. We usually make noises. One important factor that can transform Indian oil seeds is to bring multiple technologies in oil seeds cultivation, including biotechnology, use information technology, use satellite technology, use nuclear agriculture technology. Multiple technologies are required, number one. Number two, we need creative disruption. And between you and me, I'm actually working on a policy paper for the oilseed sector. It'll probably take a week or 10 days for me to finalize.
Sure. Let's do a rapid fire question round among the three of you. Two questions I'll ask. Let me ask the first question.
But pardon my interruption. I was told we need to probably wind up by 5:30. It's
Yeah, so
5:32,
just
but you
it
can
won't,
maybe
it
another
won't take
3
more
minutes.
than 1 minute. Rapid fire question.
Perfect.
We can go in the same crude, crop,
Yeah.
and currency in that
Yeah,
sequence.
yeah.
Question is, RBI is going to increase the rates? Yes, no, in the next 6 months' time. Chandrasekhar, we start with you.
Yes, I expect RBI to increase.
Okay. Rajniji, you?
I think one interest rate hike in the 6 months, yes.
Okay. And Jairamji?
I expect them to hike in June.
Hike in June. Okay. Yeah. How many basis points in the whole year, FY23? Chandrasekharji?
75 to 100 basis points.
Okay. Rajniji?
We would put it at 25 to 50 basis points, given our estimates on CPI.
Sure. We just want a figure. Jairamji, to your mind? 50 basis points. So we have basically 25 to 52 panelists and 75 to 100 basis point, Mr. Chandrasekhar. Thank you so much, all three of you. It has been really a good and very, very knowledgeable exchange of views across various domains, not just impacting the Indian markets, but also covering the global markets. And what words to say, you have covered every single gamut and answered all the questions. Thank you so much for being with us and sharing your knowledge. Thank you so much.
Thank you very much. Thank you IMC for the opportunity.
Thank you everyone.
Thank you. Wonderful. Thank you, Atul, for